Hi everybody, welcome to another update on the gold forecaster index, the holy grail to predicting gold prices. In my last video I said that it was not the time to buy gold yet. Let's see what has happened since then. We were at 1850 and well, it has gone up a bit, but it retraced again. So nothing has happened really. On silver, we see that it has actually gone down since January. So I was right on silver. So what is the gold forecaster index uh, going to predict forecasts today? So here you can see the gold forecaster index, the red line, which will predict the gold prices 2 months in advance. And you can see that we have a small bounce, but it's not nearly enough uh, to get back above zero. So we're still in negative territory, which means that gold will be very weak and silver as well. Taylor roll rate is crashing back down. This trend is going to continue, so that's very bad for gold. You want to have a high Taylor roll rate, uh, and that is not the case here. So, yep, also bad for gold. Misery index is also crashing, unemployment going down, and we have disinflation. This is also bad for gold. We got some new numbers on real outputs. It's good. It's above zero, so that could support gold a bit. Typically, when we have a negative green line, then that's bad for gold, but we are still positive. So there is some hope supporting it upwards. Chile and Peru production is making new highs. This is not good for silver as a byproduct. Peru is also at a high, but yeah, the forecast is that copper production is going down due to the problems within Peru, and also due to the Las Bambas mine that is closed right now. So could be going down a bit, that production. So less silver produced. This I have talked before. We see a huge gap between GLD and the gold price. So this is the gold price, blue, and will probably gap back down. So I expect weakness in gold. The new numbers on China, gold demand is steady, but look at silver. Silver demand is very low in China. No demand in silver. So silver will probably underperform. Same here, we got this gap up and there is no increase in the silver ounces. So this will probably gap back down to $20 for silver. We also have new numbers on central bank gold reserves. China bought, Turkey bought, and Middle East is buying. So it's typically just India and Turkey that are buying, and the rest is actually not buying. China started buying in the last quarter. So yeah, there is some central bank gold buying, but it's not like it's not a lot. US mint sales were actually good in January, so that's a good sign. Premiums are still down, so I don't expect a lot of strength in gold and silver. All the premiums are down. PSLV premiums are also down, not good. Managed money index is also very low, so there could be a gap down in gold and silver. So yeah, generally I'm not that bullish at the moment. Let's take a look at the current lease rates. So for gold, it's some is down and some are up, so mixed. But look at silver, this is crashing down. So I would evacuate the silver market right now because this looks very bad for silver. Typically, when the lease rates go down, you should see an up move in silver. That is not happening. So when we have moved down and we go back up, then you see silver crashing. And that is what I expect. When we see this go down, then we see silver crashing when this goes back up. So down, going back up, and then crash. So I would not stay in silver at this moment. Tips are bottoming out. Real yields are going more positive, so this is going down, gold will follow. Seasonality also very bad. We are in February and going down in March. Silver here as well, February down in March. So this is not the best time to buy because China has already bought it and is now not going to buy anymore. Bad seasonality. Also here, sentiment on gold miners is skyrocketing. Everyone is telling me to buy gold, which I'm absolutely not doing. That's because this sentiment is going up and now it will probably come back down. So just do the opposite what everyone tells you to do. Let's take a quick look at the stock forecast index. I want to cover this as well. Stocks are going to be very stable. So this is a stock forecast index. It's very correlated to the stock market and we are just floating around in positive territory. So stocks will probably move up very slowly. This is the Brave Butter Skelly leading index. This is one of my favorite indicators because it's based on 420 macroeconomic indicators and it is actually going back positive. So you can expect the economy to recover in about 6 months from now. So this chart will start rising again. There could be a lag, a delay on that, but it's looking very good that this red line is going back up. Yardeni, I really love this person. This is a doctor and a former Fed member. So he gives these forecasts and apparently stocks will be going up 10% in the next 2 years. And these forecasts, I have looked at them a lot and they are pretty on point. You can look at the other things as well. Margin debt is also very low at the moment, so I don't see a spectacular crash event happening. Smart money index is a bit negative for February, but in March we should be positive again. So no big crashes, maybe 1 to 2% down in February and then going back up in March. Here this as well. This is actually the corporate profits forecasts using the deficits and consumer savings numbers. So this is how much of liquidity is going into the system by government deficits and less consumer savings. And the chart is going up. Okay, so I expect profits to be stable. Liquidity is coming down a bit, but it's making a base at the moment. Let's see how this evolves. And that depends on the Fed QE, which is now in QT mode. We have the TGA account that's being drained, so that's good. And reverse repo, we still have a lot of this. So I think this can stay stable for a few months, and then we will see. Goods spending predicts recessions. Goods spending is below zero, but it's not like it's crashing. So no problems yet. Citigroup Economic Surprise Index is actually in positive territory, so it goes down, up, down, up. This should be a down cycle, but we are actually going up. So this is very bullish to me. I'm still bullish on stocks. Home builders index is also up. So looking good. And here, this is another evidence that central banks are not only doing QT, there are central banks that are doing QE, and that's the Bank of Japan. So they are doing QE and counteracting the QT of the ECB and the Fed. So that's bullish. Money supply is dropping, but not that fast. The currency in circulation is still going up. That's bullish as well. Let's take a look at the deficits now. Deficit is shrinking. The latest data here shows that the deficit is still in a shrinking uptrend. Here it is going up, so we are getting surpluses on services. I mean, the US is doing well. So deficits are not rising anymore. It's in a shrinking phase. You can also see that here. The air freight price indices pointing upwards. So I think the deficits will keep on shrinking. So the trend is this way. So I expect deficits to shrink in the future. Import prices are up, export prices down. Okay. And here export price index down. So and import prices up. So basically we still have disinflation because the prices are down. And imports and exports, there's still a gap between the two, and that's where the deficits come from. But yeah, this is going down. That means that GDP is not that strong. So GDP is actually flat at 0 to 1%. So not a lot of growth, but we can manage. Let's take a look at the Fed rate hike probabilities. They're saying that they could raise rates to 5 to 6% even. The evidence says it's starting to point back up. So maybe we could go even to 5%. But yeah, the Fed is just looking at this chart. Currently, it's still flat, so I don't think they can hike much more. Capacity utilization is down a bit from 80 to 78.7%. That's disinflationary. So the trend is that there is disinflation, and that's of course not good for gold. Stocks will go up. Look at this cycle. The kitchen cycle is bottoming out, and the juggler cycle is also bottoming out. So I expect stocks to rise in the coming 2 years. Margin debt is also very low compared to the market cap. So these are typically bottoms. I don't expect any crashes anymore because margin debt is very low now. Could go down a bit, but crashes are unlikely to happen. Now on to some energy and oil and gas charts. We know that India and China are the two biggest populations, and they are going to need energy. If they want to go to this United States point here with high GDP per capita, then they will use much more energy per capita. So this is going to shift to the right and upwards. So you can't stop India and China from using more and more oil. That's why we're invested in oil. Oil production is starting to peak out. So this was the shale revolution. This is still dropping. And now shale is starting to peak out as well. So we are anticipating this peak to happen at some point in the coming years. And that will be positive for oil. It's already positive because oil inventories are at multi-year lows, probably going lower. Oil is under-invested right now. Only 5% of the S&P is in energy. So capex will rise as the oil price goes up, and then we will see this rise up, and the oil price will also go higher to the $100 per barrel. That's the outlook, and that's because China is going to consume more. You know that Chinese, they save about 30% of their income. So a lot of those savings will be going into consumption. And this was a period that the Chinese were going all over the world as tourists. So this is a deficit in tourism. That has gone down due to COVID. Now they are reopening again, so this will start to go down again. So the tourism deficit will go back up, and that will have an effect on the oil price and energy price. Will probably also increase GDP all over the world, and that is what we are betting on. We stay in energy. Stocks will also benefit from this, and we are going to avoid gold at this moment because I'm not that bullish right now, especially because the gold forecaster index is still not in positive territory. And this has a very good track record of predicting the gold price. So that was the update, and I'll see you in the next video.